Welcome to VectorVest's special presentation, this week titled Protecting Profits with Market Timing. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be your presenter this evening. VectorVest has been encouraging you to protect your profits as this rally showed signs of tiring. We've been sharing the evidence to have you prepared in our daily VectorVest views and our daily color guard reports. As you know, no one times the market like VectorVest. Applying portfolio protection when VectorVest indicates the market's likely to fall is a combination that's hard to beat, and the focus of our presentation tonight. Protecting profits is a topic Dr. DeLuto has been writing about for decades and one we've been teaching for just as long. Recently, we highlighted 8 tactics in a special presentation delivered by Steve Chappell on May 22nd of this year. Here is the list of tactics as presented in that session. Steve illustrated each in turn, and we've had further demonstrations in subsequent special presentations. Before we look at the individual techniques, however, we want to remind you protecting profits is just one part of an effective risk management plan. You'd want to make sure you're managing risk appropriately when you enter the position. You should be diversifying the stocks held in your portfolio, evenly dollar weighting those positions, and adjusting the position size to limit maximum risk to 1 to 2% of the value of your portfolio after the application of your selected stop loss. So, moving into the list, number 1 is to use protective stop loss orders. Any tightening of the stops on any open trade should further reduce risk and/or lock in gains. Now, numbers 2 through 5 are option-based tactics, selling covered calls, buying put options, executing a collar option, buying index puts. Numbers 6 and 7 are hedges. A hedge is an investment that moves opposite the portfolio. In other words, a hedge is designed to increase in value as the portfolio falls, offsetting those losses. Number 8, sell the stocks outright, is our focus tonight. The surest way to protect your unrealized stock profits is to simply sell the stocks. You're fully protected against any additional loss and fully recapitalized to take advantage of the next rally. It's also pretty simple. But it does come with some trade-offs. First, you may not want to liquidate legacy stocks that are in your portfolio that you've been holding for years and have a really low cost basis. Next, unless you're selling the stocks in some sort of tax-advantaged account, such as an IRA, you'll owe tax on your capital gains. Nobody ever likes to pay tax, but at least there's something to need to pay tax on. Next, if you're wrong, you'll probably also miss out on some of the next rally as you wait for a re-entry opportunity back into the stock position. And of course, if you're right, you capture gains and you minimize drawdown in the portfolio value. So let's take a deeper look. I'm going to move into the VectorVest program. And from the home page, I'm going to the Viewers tab, and I'll open the Trading System Viewer. And we'll minimize the toolbar. 2 weeks ago, Mr. Jerry D'Ambrosio highlighted a top-performing prudent trading system, VST Rockets, with a very respectable 12% drawdown. As he pointed out, part of the reason the drawdown is modest is the portfolio goes to cash when its timing signal, the DEW, turns down. So if we go to Trading System Details and select the rules, we can see that it uses the DEW timing system, and when the condition changes to down, the portfolio closes all the positions and moves to cash. While we're here, I'll have you note that we're trading VST Rocket stocks with a recommendation equals sell stop loss, and it's a 10-stock portfolio. The DEW timing signal is a nice middle-of-the-road signal that will indicate when the market trend has changed. So let's use this trading system to illustrate a concept. To conduct an accurate comparison, I want to move into the backtester. I've created a 1-year backtest of the VST Rockets trading system as my benchmark. It's very easy to do. I'll click the Edit button. And if I select a trading system, I simply select the existing trading systems available to me in our list. Clicking VST Rockets, I can import all the settings from this trading system into my backtest. And here are the results. 64% winning trades, 104% gain overall. For this test, I let the system charge me a $4.95 commission for each trade. And again, we had a very similar max drawdown of 11.88%. On our graph below, we have the equity curve for the portfolio performance over the backtest period. When we're analyzing the performance of any backtest, one of the things we're always looking for is a system that hits consistently higher highs over time. But you might have noticed also in that equity curve, there are a couple flat lines in that equity curve when the portfolio went back to cash because of a DEW down signal. And this worked very well. Our first flat line, the portfolio was down 4.47%, but because we're measuring maximum drawdown from the prior high, we actually had a maximum drawdown at that point of 7.53%. The next flat line was during the COVID crash, and while the portfolio was positive, up 20.82%, that represented a maximum drawdown of 10.96%. And finally, bringing it to current, this most recent pullback had a maximum drawdown of 11.88% recorded in the max drawdown number of our portfolio performance. But remember, the thing that's making these flat lines possible is the market timing signal that's moving us to cash, indicating that it's time to get out of and then back into our campaign. For comparison, I also struck a copy of this test, but I changed the rules. We'll go into Edit, and on the down situation, instead of moving to cash, I took no action. So the timing signal is telling us when to get in with VST Rockets. And when we get the down signal, we'll take no action. We won't move to cash, meaning we'll hold the positions through the down signal and manage them on their stops, which was the VectorVest sell rating. This keeps the stocks in the portfolio as long as they behave. The price stays above the VectorVest stop price. They'll be ready to take advantage of any rally in the market. So because we're holding the stocks through the down signals, the only flat lines we see in the equity curve were during the COVID crisis when all of the stocks in the portfolio had hit their stop loss, the VectorVest sell recommendation. The first drawdown actually outperformed our base case with a maximum drawdown of 7.14%. The COVID crisis maximum drawdown was 23.31%, which was, of course, the maximum drawdown for the test period. On our current pullback, we've pulled back 11.98%. And I'd have you notice that the equity curve has taken a little bounce over the past 2 sessions because we're still holding open positions in the portfolio. And of course, if we look at the other test, that portfolio is in cash because of the DEW down signal. So here's a table comparing the maximum drawdown numbers, and we can see the portfolios run pretty well neck and neck except for that maximum drawdown during the COVID correction. And it's this kind of drawdown that can really knock us back on our heels. Let's take a look at it from another perspective. Looking at the test where we go back to cash, our baseline, the backtest peaked before the COVID correction with a gain of 32.15%. The buy and hold test peaked at 37.64%. Holding actually outperformed as the stocks continued to gain coming up off of their lows in the market pullback. However, when we look at the second half of the test, from the COVID correction forward, remember both portfolios were in cash. So both portfolios bought the same group of stocks and held them through the current time frame with the same stops. Nothing has changed other than the baseline. By truncating the pullback, our next peak in the portfolio was at 127.22%. For buy and hold, the next peak was 104.13%. Again, in table form, because it's a little easier to see the numbers, we really ran neck and neck on the first peak, but after the COVID correction, a $23,000 differential in the performance of the two methods. So holding out performs better by getting the early jump on the rally instead of waiting for the signal to get in on the first turn, but struggle to overcome the losses from holding into that correction. So which approach is better? Well, the tests indicate holding through minor pullbacks will make faster gains, but if that minor pullback becomes a correction, holding positions open into that correction can cause larger, sometimes significantly larger losses. So I'll remind you, each system is profitable over time, but empirically the data would suggest moving to cash is the better approach, particularly if you experience a market correction. But what if you didn't have to make a choice? What if you could have the best of both worlds? May we suggest to you that this is not a binary choice? The other 7 tactics are powerful tools for protecting profits and the reason learning options can be so valuable. You can see how hedging gives the best of both worlds, letting you hold your positions but protecting them against an outsized loss at a relatively low cost. When the market starts showing signs of weakness, start becoming defensive. When the market signals a downtrend, apply your chosen hedging techniques. Knowing when to apply them is critical. Protection applied too soon or too often will be costly. All protection comes at a cost, but a cost worth paying if it protects profits. And of course, we at VectorVest stand ready to help you learn these different techniques. Give us a call in product support at our toll-free number or visit the VectorVest University for more resources. Have a great evening, and thank you for watching.